Hello everyone, I'm Jerry D'Ambrosio, Manager of Educational Content here at VectorVest, and today we're talking about one of the most overlooked but critical parts of successful investing, risk management. It's easy to get caught up in stock picks or headlines and hot tips, but real progress in investing doesn't start with what you buy, it starts with how you manage risk. Because in this game, it's not just about making money, it's about keeping it. Most investors ask, what stock should I buy? Far fewer stop to ask, how much should I risk? But the truth is, no matter how good the stock is, if you risk too much and the trade goes against you, one bad move can erase months or even years of progress. Professionals don't lead with stock picks, they lead with risk. That's what keeps them in the game long enough to win. So here's the rule, plain and simple. Never risk more than 1 to 2% of your account on any single trade. Notice I said risk. That's not the same as the size of the investment. In other words, the stop determines your position size. The math makes the decision, not your emotions. Now, why is this rule so important? Because big losses are killers. Look at it this way. A 10% loss requires just an 11% gain to break even. A 25% loss requires a 33% gain. 50% loss requires the stock to double before you break even. And if you lose 75%, you need a 300% gain just to get back to where you started. That's the math of survival. Small losses are recoverable. Big losses can be fatal. But it's not just math. Big losses also crush your confidence. You start every day in the red. You hesitate to make decisions, and you feel defeated before you even begin. On the other hand, small, controlled losses keep your head clear and your optimism alive. You can reset and move forward. That's why the 1 to 2% rule isn't optional, it's essential. Let me show you how it works in real life. We'll look at a few chart examples in a moment, a few stock examples. But let's just go through the math here, and this formula, this calculation, is what you would apply to each stock that you're looking at. Imagine you have a $50,000 account. You've decided to risk 1% per trade. That's a maximum loss of $500. Now suppose you're looking at a stock and it's trading at $82.50 with a stop at 78. Now let's just say, for example, that's the VectorVest stop price the day you're looking at the stock. This is not a demonstration or a presentation on how to set the right stop loss or where to set the right stop loss. There's a lot of different ways to do that. You can use the VectorVest stop price as kind of a starting point. You can use support levels and moving averages. There's a lot of different things that you can do in terms of setting stop losses on individual stocks. Again, I think the VectorVest stop price is a great starting point when you take the trade. Write that number down. Write what the value of the stop price was on the day that you're looking at the stock. So in this case, if we're looking at a stock's price of $82.50 with a stop price of 78, that is $4.50 of risk, right? You're risking $4.50 per share. Is you take your risk, which is $500, divide that by your risk per share, which is $4.50, and it gives you a share amount of 111 shares. You take that, you multiply it by the stock price, and that gives you a cost basis of $9,158. Very simple. Notice what happened. You didn't pick the number of shares. The math did. That's discipline. And that's survival. Here's why this matters. It limits every loss to something you can recover from. It keeps your portfolio intact through losing streaks, and they will come. And most importantly, it builds your confidence and consistency. Remember, we don't control the outcome of any single trade, but we do control the risk. Let's hop right in and take a look at a couple of examples. These are just top VST stocks in the S&P 500 watch list. We are familiar with Google. Google right now is trading at $235.15, going parabolic essentially, right? This is not a suggestion or a recommendation to go out and buy Google, but this is an exercise in calculating how much of a cost basis you could have or should have if you were to buy Google now with the setup the way it is. So $235 stock price. The stop is $197.90. So that's roughly a $38 difference between the current price and the stop price, right? So I'm going to pull up my calculator. If I don't want to risk more than $500 on the trade, which again is 1% of my hypothetical $50,000 portfolio. By the way, this number will either increase or decrease over time. If the portfolio value grows to $60,000, then $600 would be 1% of that, and that's how much you would risk on future trades with that account size at $60K. If it happens to drop down to $40K, then of course $400 would be your risk on any given trade moving forward. So $500 risk, divide that by, we're looking at about a $38 difference between the current price and the stop price. We are to buy 13 shares. Multiply 13 times the current price, which is $235, and that very quickly spits out a cost basis of about $3,092. It's a smaller position size than we may initially want to take, right? Let's say we got $50,000 and you want to maintain 10 positions. That would initially require you to put $5,000 into each stock, right? That's your starting point. You want to be in that range because that is more of a dollar-weighted portfolio. Sometimes you can leverage up. In this case, we would have to buy less shares because it's a little bit of a riskier trade at this point, right? There's such a wide difference between the current price and the stop price. If that difference was smaller, the position size could be larger. So it all depends on the risk on any one trade. Let's go through another example. We'll look at ANET, just another top VST stock in the S&P 500 watch list. Current price of 142, current stop price at 119. That is a difference of $23. Okay, so we're going to take our initial risk, again 500, divide that by risk per share, which is 23. 21 shares, we'll round that up to 22 shares. You multiply that by the current price of the stock, which is roughly 142, we'll say 15. And there your cost basis is right around the same, almost $3,000. Again, because the difference here, we're looking at a 142 price, 119, 120 stop price. That's $22 on a $142 stock. Talking almost 15% there, right? So the size of the position would have to be a little smaller. STX, $184 stock price, $157 stop price. That is a difference of $27. That is your risk per share. So again, taking out your little calculator, 500, which is your initial risk, it's 1% of the portfolio value. Divide that by your risk per share, which is $27. We'll round that up to 19 shares, or you can just multiply it by the current price, which is about $183.45. We're talking about a $3,400 cost basis. Maybe again a little bit lower than what you would ideally want to put in. We're talking about $5,000 into each position ideally in this case, or in these cases, because there's such a wide difference between the stock's price and our stop price that it requires you to buy less shares because the risk is a little greater. There will be times where it's a low risk trade or a lower risk trade and you can leverage up, you can buy more shares. Maybe the size of your position will be a little bit more than 5,000, maybe 6,000 or 7,000. You're not risking any more by buying more shares. Okay, so here's the big takeaway. Winning in the stock market isn't about swinging for home runs. It's about avoiding strikeouts. The 1 to 2% risk rule is your shield. It keeps your losses small, your emotions stable, and your portfolio alive long enough to enjoy the wins. So here's your action step for this weekend. Take a look at your open positions. Ask yourself, if I get stopped out tomorrow, is my loss under 2% of my account? If not, adjust it. That one change could be the reason you're still investing 5 years from now while others are out of the game. Thank you everyone for watching. As always, if you have any questions, let us know, and we'll see everybody again next week. Take care, folks.
VectorVest.